In today's market update, we're going to be taking a step back and taking a look at the longer-term implications of the recent bearish price action that we have seen in the S&P 500, working with SPX data. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So here is the analysis that we've been looking at in the S&P 500 over recent months. We have, of course, the 18-month cycle trough in October of last year, 2022. That is probably, in my opinion, a longer cycle trough of 54-month magnitude, and that is, of course, what we're going to be taking a look at when we take a step back. That 54-month cycle diamond, as a matter of interest, is not positioned on this particular analysis because I do monitor different analyses on my charts, and this is one that has the 54-month cycle trough still ahead of us, which we'll be discussing a little later in today's video. The important thing recently is that we had a 40-week cycle trough that formed over here in the middle of August. You will know, if you've been watching these market update videos over recent weeks, that there has been some discussion about the position of that 40-week cycle trough. But the recent bearish price move, as price dropped down to a new low, as expected last week, confirms, in my opinion, that the 40-week cycle trough did form in the middle of August, as shown in this analysis. And there is a very simple rule of thumb that I use for confirmation of these cycle troughs. That is to measure the number of days that elapse between two potential cycle troughs. So counting the number of days from the 18-month cycle trough in October of last year up until the middle of August, when the 40-week cycle trough probably formed, we measure 309 days, as you can see there, 44.3 weeks. We do count calendar days, I should point out. We're often asked, is this calendar days or trading days? It is calendar days that we count, which is something that Hurst discovered 50 years ago when he was performing his research into financial markets. And so the rule of thumb that I use when we are considering a potential cycle trough is to simply look at what happened halfway up to that cycle trough. So we have a length of 309 or 310 days. Halfway up to that point would have been 155 days. We go back to a count of 155 days and ask ourselves whether there is evidence of a shorter cycle forming a trough at that time, which of course in this case there clearly was. 155 days from the October 2022 trough was on the 17th of March of this year, and you can see that we have a 20-week cycle trough over here just 4 days before that on the 13th of March. So it was very close in time, and that kind of regularity in cycle wavelengths is what we are looking at for evidence that the 40-week cycle trough did in fact form here, because what it means is that we have two almost equal length 20-week cycles. There are other possible positions for this 40-week cycle trough, as we have discussed in recent market update videos, including this trough over here, there's a trough there, and of course that trough that formed there. And it is just possible that the 40-week cycle trough is going to form very late, but the fact that we have this good symmetry between these two 20-week cycle wavelengths increases my confidence in the fact that the 40-week cycle trough did form in the middle of August. If we consider what has happened since the middle of August, you can see that price bounced out of our 40-week cycle trough, but then it started moving down, and it has then bounced up out of a 40-day cycle trough and has recently headed down into an 80-day cycle trough. We'll zoom in a moment to take a look at a little more detail. The important thing is that this is a very bearish cycle shape. Cycles form M shapes in financial markets. When a cycle is bullish, that M shape gets distorted to the upside, forming a late cycle peak and of course bringing price to end the cycle wave at a higher level than the level at which it started it. But what we have seen in this example is exactly the opposite. This is in fact a very bearish cycle wave. Let's zoom in and take a look at just a little more detail. Here is that M shape for this 80-day cycle. It is, as I've mentioned, very bearish because it has an early peak. The peak formed well before the midpoint of the cycle, and it has of course brought price much lower than the level at which it started. That is by definition a bearish cycle shape. What we are expecting now is for the 80-day cycle trough to form in the markets. The average length of an 80-day cycle is 68 days, and if you don't understand why that is, I would encourage you to download the 10 Core Concepts document that I will provide a link to in the description below this video, which explains these basic ideas. And so as of today, and I'm recording this video before the US markets open on Monday the 30th of October, but today is counted as a bar, and so as of today there have been 73 days that have elapsed since the middle of August, since that 40-week cycle trough, and so we are about 5 days overdue for an 80-day cycle trough to form. However, as you can see, the recent average wavelength of the 80-day cycle has been 77.3 days, and so we might still have a few days ahead of us. Of course, these cycles are dynamic. Their wavelengths are not absolutely fixed, and so our analysis provides us with an expectation of when a trough is likely to form. We need to monitor price action very carefully in order to determine when exactly that trough has formed. That is probably the kind of thing that you would want to do on an intraday basis, watching shorter cycle FLDs, the 5-day, the 2-day, and even the 1-day cycle FLDs being crossed to the upside in order to confirm that that 80-day cycle trough is forming. But now let's zoom out again and consider what the implications are of this bearish 80-day cycle. There is that 80-day cycle. Considering the fact that we had a 40-week cycle trough forming in the middle of August, why is this such a bearish 80-day cycle? Surely the first 80-day cycle following a 40-week cycle trough should be a bullish one, because the 20-week cycles and the 40-week cycles are both pushing upwards. That is indeed the case. So why is this a bearish cycle? This must be a bearish cycle because of the pressure of longer cycles. Of course, the 18-month cycle, which started up in October of last year, will now have turned down, and so the 18-month cycle is pushing downwards. What about even longer cycles? That brings us back to the question of where this 54-month cycle trough formed. We're going to postpone answering that question until we're looking at a much bigger picture. But for now, it's important to bear in mind that there is evidence in this bearish cycle for the fact that the longer cycles have turned bearish and we are getting a lot of bearish pressure. What is going to happen next? In other words, the next 80-day cycle. Is it going to be a more bearish or a more bullish cycle than the one we have just experienced? If this analysis is correct, and we have no reason to suppose that it isn't, then the next 80-day cycle is expected to be more bearish as price heads down into the 20-week cycle trough that you can see we are expecting over here in about January of next year. That is therefore a bearish warning. We should be standing by for some bearish cycle action. If we display the composite model line, which is a useful tool in Sentient Trader that takes all of the analysis information contained in the foot of the chart, recomposes that information, including the amplitude and wavelength of each one of the cycles that I have selected to include in the composite model line, you can see that this line is warning us to expect some bearish cycle shapes moving ahead. First of all, into the 20-week cycle trough expected in about January, and then continued bearish price action all the way into about the middle of next year, which is when the next 18-month cycle and possibly longer cycle troughs are expected. So there is certainly a bearish picture in terms of the cycle analysis on our charts. Let's zoom out now and take a look at this longer-term picture and see how this fits into what we are expecting expecting in the longer term. Here is a monthly chart of the SPX data, and you can see that I am displaying semicircles for the 9-year cycles and the 54-month cycles that have been found in this analysis. The 9-year cycle is the longest cycle that has been found in this analysis by Sentient Trader. Why is it that the software hasn't positioned an 18-year cycle, which is the next longest cycle according to the nominal model defined by Hurst in the 1970s? The reason that Sentient Trader hasn't positioned that 18-year cycle trough, the reason that Sentient Trader hasn't included that 18-year cycle in this analysis is because of the fact that it doesn't really have quite enough data. You can see that it has found only 1, 2, 3 9-year cycle troughs. To convincingly position the 18-year cycle within that, it needs to identify one more 9-year cycle. We could, of course, analyze more data and force it to identify the position of the 18-year cycle, but in fact that's not really necessary. Let me show you how we can very simply determine where the 18-year cycle trough is most likely to be. Because there must be an 18-year cycle trough synchronous with every second 9-year cycle trough, that means that either this here is an 18-year cycle trough as well as this trough over here, or it means that the 18-year cycle trough formed over here, and then we are expecting another 18-year cycle trough over here in about 2027. Let's compare those two possibilities just for the sake of pursuing this argument to its bitter end. Here we are going to take a look at the first possibility, which is that the 18-year cycle trough formed in 1998. We would have a move up, then a move down into a 9-year cycle trough, then a move up into the peak of the next 9-year cycle, and then a move down into that trough. That is what I call an inverted cycle shape, because of the fact that the center of the M shape formed by the cycles is lower than both the start and the end. It is not an impossible situation, but it is unlikely that a very big magnitude cycle such as the 18-year cycle would have formed an inverted cycle shape on our chart. What is much more likely is the other option, which is that this over here in 2009 was the 18-year cycle, in which case the cycle shapes that we have seen since then have been a very strong bullish move up, then down into the 9-year cycle trough over here in December of 2018, and we're going to discuss that in just a moment. And then we have since then seen more bullish action as price rose up to this peak that formed right at the end of 2021. There is no inversion there. The M shape that is unfolding is simply a very bullish one so far. Of course, the next move that we are expecting is the final leg of the M shape, which is why I thought it would be useful to take a look at a longer-term picture, because what we're looking at is some serious bearish action lying ahead of us. So let's make the assumption then that the 18-year cycle trough did form over here in March of 2009. Let's quickly discuss this 9-year cycle trough position. I've mentioned this in previous market update videos. I think that it is most likely that this important cycle trough formed in December of 2018 as opposed to the lower price trough that formed in March of 2020. The reason for that is because this trough that formed down here was a result of fundamental interaction. I call this the pandemic trough. That is when, of course, the COVID pandemic was sweeping around the world in early 2020. And it is my opinion that price was distorted further to the downside because of that news event, because of that fundamental interaction with the price movement, and that the correct placement of the 9-year cycle trough over here is in the end of 2018. That means that this March 2020 trough was a trough of 18-month magnitude. The next 18-month cycle trough was this one over here in October of 2021. and then the third 18-month cycle came to an end with a trough in October of last year, meaning that this would then be a 54-month cycle trough. The alternate view, and I'm not going to present a detailed argument for the alternate view because I would like to pursue this particular analysis further, but the alternate view is, of course, that the 9-year cycle trough did form in March of 2020, that this was not a lower trough because of fundamental interaction, and therefore this trough in October of 2022 was only the second 18-month cycle. Therefore, the third 18-month cycle is going to come to an end over here in early 2024, and that would then be the position for the 54-month cycle. We're going to bear that in mind as we take a look at the longer-term picture. And so, stepping back again, assuming that we had an 18-year cycle trough here in 2009, we then experienced the next 9-year cycle trough over here at the end of 2018. What has happened since then is that we have seen the first 54-month cycle, according to this analysis, with a little bit of a deviation caused by the pandemic in March of 2020. And so here is the important question. What are we expecting next? Well, it is fairly obvious that this first 9-year cycle from 2009 to 2018 was a very bullish cycle. The next 9-year cycle is, of course, expected to be less bullish as price moves down into the next 18-year cycle trough, which we would be expecting in 2027. And so far, we could argue that the current 9-year cycle has turned out to be a little less bullish. We have, of course, had this strong bullish move up, distorted a little bit because of the pandemic, but then we have had a fairly impressive move down, a greater move down than can be seen in the earlier 9-year cycle. Price has bounced out of the midpoint, the 54-month cycle, but importantly, it has not formed a new higher peak. That is a bearish sign. And so to complete the M shape of the current 9-year cycle, we are indeed entering into the final leg of this M shape. That indicates that we are expecting a bearish move not only into early next year, when the next 18-month cycle trough is expected, but in fact potentially all the way into 2027, when we are expecting the next 18-year cycle trough. Now, these kinds of very long-term analyses are a dangerous thing to do when it comes to cycle analysis, because in a few years' time somebody could pull up this old video and point out how wrong I have been if price has not moved down for several years following this video. It's important to bear in mind that we reassess our analysis with each new piece of data. But I do believe that there is a potential warning for some increased bearish activity all the way into 2027. As a matter of interest, if we display the composite model line on this analysis, you can see several things. First of all, it matches the past price action fairly well. All that tells us is that the analysis provides a good analysis of past price action. If we zoom in on that and consider the same composite model line, you can see the line is warning that price is going to move down into this trough in early 2024, which is expected to be the next 18-month cycle trough. And then the composite model line suggests that we might see price bouncing up to another and new all-time high. The reason for that is because of the information that it has for the 54-month cycle, which should, of course, still be bullish. Displaying our semicircles again, you can see that the 54-month cycle is, of course, still rising. That is why the composite model line considers it possible that price will reach up to a new all-time high. After which, though, the market is going to turn very bearish for the move down into the next probably 18-year cycle trough, expected here sometime in 2027. And so the composite model line gives us a little bit of hope that the bear hasn't taken complete control just yet. The important things for us to look out for are, of course, the fact that price is going to move down into this 18-month cycle trough expected early next year, and so the bear is definitely not over just yet. As price bounces out of that 18-month cycle trough, we are going to see how strong the 54-month cycle is in terms of influencing price to move up to a new high. The fact that price failed to make a new high over here indicates some weakness in that 54-month cycle, in my opinion, because if the 54-month cycle did form a trough over here, it really should have had greater pushing power to enable us to get up above the previous high. And so I'm not holding my breath for another all-time high over here. We will certainly see price rising up into another peak, but the important message that I would like to convey in today's video is this strong bearish move that we are looking at coming into the 2027 18-year cycle trough. I do hope you found this market update useful and interesting, taking a step back and considering the longer term picture. If you have any questions, please put them in the comments below this video or join us on our Discord server.